Okay, so today I'm going to talk about a strategy that has outperformed the broader market index by a good 10%, and remarkably, this has been done over a 45-year period. To put it in numbers, this annualized return of 21.19% from the year 1964, from January of 1964 until December of 2009 would have turned $10,000 into a little over 69 million. This weapon of mass value creation is called the trending value strategy and was first put forth by James O'Shaughnessy in his book What Works on Wall Street. The book itself revolves around identifying winning investment strategies by backtesting and analyzing historical market data, and while it's obviously good and informative, I personally found the book a bit too data intensive, which makes this video all the more important as we look at the key parts of that study and try to apply it in the Indian environment. Let's begin. The phrase trending value, as you might have guessed by now, is two words, trending and value. And because trending means momentum, presumptively the strategy aims to maximize the potential of both momentum investing and value investing. I approached this topic in a previous video as well, and while that was about allocating half a portfolio to momentum and value, which by the way gave us a 16.2% annualized return over 17 years, this trending value strategy aims to give us the best of both worlds by not only selecting stocks that are undervalued, but ones that have also demonstrated strong price momentum. In fact, O'Shaughnessy explains it with numbers, and while the index compounded at 11.2% over 45 years, look what happens when he applies these two factors individually. Okay, so if O'Shaughnessy had bought only undervalued stocks using his Value Composite 2 indicator, which we'll learn in just a minute, then that would have delivered 17.3% on an annualized basis. And instead, if only a momentum strategy was used, that is buying stocks with the best 6-month price appreciation, then that factor in isolation would have given us 14.5% per annum. But O'Shaughnessy decided to combine value and momentum, and when applied and backtested, this trending value strategy would have achieved an average yearly return of 21.2% over 45 years. So this techno-fundamental portfolio not only outperforms the index, but also does better than the single factor strategies with the added advantage of lower volatility. If this sounds impressive, then let's get into the specifics on how to construct one in the next section. We start with the calculation of a value score, and this comprises of 6 different metrics. The price to earnings multiple, that is the current share price divided by the EPS, and the lower this is, the better. Secondly, there's price to book value, a very popular metric for capital intensive businesses, and again lower is better. Then there is price to cash flow from operations, which helps investors gauge how the market values a company's cash flow generating capability, and a lower number certainly makes it an attractive investment. Number 4 is price to sales, which is O'Shaughnessy's favorite metric, and of course lower is better. Then we have EV to EBITDA, which is amongst my favorite metrics and assesses a company's overall value, so market cap and debt, in relation to its earnings, and typically a lower number is always better. And the 6th and final variable is dividend yield, and companies offering a higher dividend relative to its share price is always better. I should point out here the author made many improvements in the methodology across editions, and that's why you might find shareholder yield in lieu of dividend yield, but that's not a big botheration, at least in an Indian context. Okay, so these 6 variables are the key to unlocking what is called a value composite score, and here's how I went about it. So step 1 is to define the universe, and because I wanted a large and relevant base, I settled for companies with a market cap of at least 500 crores, which on a screener yielded me a little over 1,500 companies. Step 2 is to collect the required information, that is the P ratio, the PB ratio, EV on EBITDA, etc. And an arrangement of columns on your screener should give you the necessary data. Step 3 is to download this information on a worksheet for easier handling, and you can always access my sheet whose link I have already attached in this video's description. Okay, step 4 is important, and what we want to do now is to allocate a decile for every company across the 6 variables. So with regards to P ratio, I first ranked all 1,521 companies and then assigned a score to these ranks in multiples of 150. For example, Coal India with a P multiple of 7.1 is ranked 58th in my list, which means it lies within the first decile, that is rank 1 to rank 150, and therefore is assigned 1 point. Similarly, TCS has a rank of 623, which means it lies in the 5th decile and receives 5 points. Step 5 is to do this exercise across all 6 variables. And as you might have guessed by now, a score of 1 means the company is undervalued on that particular parameter. And as the score goes higher, it means the company is getting more expensive from a valuation perspective. And the last step, step 6 for finding the value score, is to add up all the scores across all 6 metrics, which will give us a cumulative score for every company. For instance, in my list, the company with the lowest score is SPIC, Southern Petrochemicals Industries Corporation Limited, with a cumulative value score of 7, and one of the highest value scores goes to this company, National Standard India Limited, which is in the real estate business and is currently engaged in the construction of a residential project in Thane. The next part when implementing the trending value strategy is to arrive at the momentum score, and very simply we're looking for companies whose stock has been performing well over a defined period of time. For this, we'll use a 6-month price return, that is, stocks whose price has risen the most in the past 6 months. But before extracting that data, it's important to reduce our universe to only those companies that are in the top decile as per their combined value scores. Like in our case, the top decile is 1500 divided by 10. So the top 150 companies, which in our list is a value score ranging from 7 to 16. In fact, in the book, O'Shaughnessy had this really interesting table which features the annualized returns across different deciles, and performance up till the 4th decile seems to be higher than what the index has delivered over 45 years. So anyways, we need to add momentum over this data, which means it's time to go back to the screener and pull out the 6 monthly share price return for each of these stocks. We then sort it in descending order, and from this list, the top 25 stocks are chosen, and these 25 stocks are what comprises our trending value portfolio. Now, 25 is just an arbitrary number, and this could have been 50 as well. And O'Shaughnessy did try out different combinations that he's described in his book, and it seems 25 is where he received the highest and therefore the best risk-adjusted portfolio returns. This 25 stock portfolio is then rebalanced on an annual basis, so once a year. And if you're keen to try this out, as of 10th of November 2023, these 25 stocks would make up the trending value portfolio. Understandably, each of these stocks displayed value characteristics in terms of a low P ratio, a low PB ratio, attractive price to sales, etc. But I did have some observations that I think we would do well to understand before implementing a strategy like this. So firstly, notice the price movement, and a lot of the price appreciation has happened in the last 3 years, which certainly ascribes to the momentum part of the strategy. In fact, most of these stocks were almost in hibernation between 2018 and 2020 when the growth strategy was hogging the limelight. But as soon as value stocks started getting attention, there was a massive price jump in these stocks, which probably means A, we need to be mindful of the fact that the prevailing style in the market, that is growth or value, will have a bearing on how these stocks perform. And secondly, rebalancing the portfolio once a year, which is what O'Shaughnessy recommends, becomes all the more important. Additionally, I also looked at some key metrics we had learned in my previous video, and when it comes to the ROC, many of these stocks are in single digit, which is generally the case with classical value investing. In terms of sales growth, again, a lot of it is in single digits. But having said this, the EPS growth has been a lot better, which again explains the cyclical nature of these stocks. My own assessment is to look at this more as a value portfolio, with the momentum part of the strategy just about giving us the assurance that these stocks are not falling into a value trap. Now, the reason why you're watching this video is not so much to understand this approach, but in all probability, you are here to see how this strategy has performed in an Indian environment. Now, because I don't have access to software that allows me to backtest data over many years, I'm borrowing this study done by Capital Mind, wherein the team there backtested the trending value strategy on Indian stocks over a 16-year time frame, that is from 2007 until 2023. You can read specifics in the article I've attached in this video's description, but here's a quick synopsis of what those guys discovered. Number one, in terms of market capitalization, a majority of the trades, almost 79%, were with companies that were ranked between 500 and 1,500 in terms of their market cap, suggesting that the trending value strategy is generally a small cap strategy. Secondly, and even from a returns perspective, it's the microcaps who were the biggest winners, and that's where this strategy truly thrives. And in terms of numbers, the study by Capital Mind delivered a CAGR of 20.6% over a 16-year period, while the Nifty 50 came up with only 9.9%, which gives us a 10% alpha that is in line with what O'Shaughnessy also found in his study. However, while the trending value strategy is expected to reduce volatility and the impact of drawdowns, in an Indian context, the study revealed an opposite effect to these two parameters, and there is justification for that as the strategy seems to favor small and micro caps, which often display a much higher level of volatility and drawdowns. In fact, the team at Capital Mind also looked at rolling returns over a 10-year period, and the table here clearly shows a consistent outperformance of this strategy when compared to the Nifty 50. So a 10% alpha over the index might sound too good to be true, and it is true. But before you start rolling the carpet, here's a quick recap of what we have learned so far. Firstly, the trending value strategy is clearly a small and micro cap strategy, and therefore mimics these market cycles which generally offer high returns but are also extremely volatile. Point 2, please expect a predominance of value stocks, that is companies trading at a P ratio of less than 12 and companies whose annual sales are more than its market capitalization. Number 3, very important, returns from this strategy will often come in bulk. And what I mean by this is that there will be a few quarters and even years when the performance is muted, and then there will suddenly be a spike, which is what happened from 2020 onwards to many of the 25 stocks that we picked from our screeners. And finally, remember, this strategy will not suit everyone. Essentially, this is not something growth stock oriented investors will appreciate. And even otherwise, the trending value seems to be a high risk, high reward strategy that requires an even higher tolerance for volatility. But as it stands, the trending value strategy has done well in many markets across the world, and it's certainly something you should understand and keep as a part of your investing toolkit. I sincerely hope you found this video useful and informative. Please do press the like button, do share it with your friends. Thank you for your time, and I'll see you 3 days from now. Until then.